Welcome back to the Market Insights webinar. This is Kevin Prince from BMO Exchange Traded Funds, and I got to say thank you again for joining us and getting some good education and insights towards exchange traded funds and the overall market. Now, we always like to start this session off with a little bit of disclaimer, so let's kick into that. And what are we saying in our disclaimer here? We're saying we're not going to provide you specific recommendations nor specific advice. What we really want to do is focus on education with a tilt towards exchange traded funds. So with that, let me introduce my guests today. I am joined by Mackenzie Bausch, who's a Senior Product Manager at BMO Global Asset Management. Thank you for joining us again, Mackenzie. Appreciate that. And I should note, Mackenzie's going to be around for just a little bit longer because she's soon to be a new mom. So thanks for taking the time to join us today, Mackenzie. Hey, Chris Heeks is also joining us too. Chris Heeks is a Portfolio Manager at BMO Exchange Traded Funds. And Chris is going to be leading in the conversation today because we're going to focus in on low volatility investing. And Chris has actually been helpful in developing low volatility investing as well as oversees the portfolios that BMO runs. So we'll get into low volatility investing just in a sec. Now, before I do that, Chris, because you're on the portfolio management team and on the desk, you see a lot of insights towards what's going on in the marketplace itself. Maybe you can share some of the trends you've seen more recently this week with the audience, please.
For sure. Thanks, Kevin. And hello to everyone out there. It's been another strong week overall in equity markets. We're at essentially all-time highs in the US and Canada, and the market's chugging along. The two big themes that I see that continue to play out are, the rollout of the vaccinations and continued stimulus from monetary and fiscal authorities. So when you put those two things together, we've had a pretty bullish environment for equities overall, and we've seen that this week. And the reopening trade, as some like to call it, I think has been overall in effect. We're seeing sectors like financials do quite well, materials and energy. We're also seeing factors like value and dividends performing well. So overall, it's a good backdrop for equities, but I think it also sets us up well for this call, because obviously anytime the market gets higher and higher, I think, Kevin, is a good time to start thinking about volatility. Usually people don't think about volatility until it's a little bit too late. So I think it's a great time with the market at the all-time highs to have a discussion about low volatility investing.
Thanks for that insight, Chris. Appreciate it. Let's get into the topic here, low volatility. Thanks for that piece too there, Chris. Mackenzie, we always like to start off with a tool to help people do their own research in the marketplace. Let's give the audience here a little bit of insight about the CFA Institute and how they can get some information themselves and research.
Sure, thanks, Kevin, and thanks for having me today, and thanks for everyone for joining. The CFA Institute website has a ton of research on various different topics, and it's something I would encourage everyone to go and look at. Now, you will need to log in and register. Anyone can log in and register, but once you do, there are tons of reports and PDFs, webinars, and videos supporting various different topics. Specifically on low volatility, they have a ton of different research papers from experts in the field that really go deep. So if you want to learn more, whether it be through papers or videos or different webinars, I would encourage you to explore this website and look a little bit deeper on various different topics.
Thanks for that, Mackenzie. Now, the research paper on the page talks about the low volatility anomaly. Of course, that's research you can do yourself. But Mackenzie, maybe give us a little bit of overview. When we say the low volatility anomaly, what are you talking about?
Sure, and I think low volatility is something we see a lot in the headlines, a lot in the news, and I think it's something that really resonates with investors. It's something they're drawn to. So low volatility, first off, stocks, those are less price. They have less price variability than the average market. So when we look at that and you think of low volatility, often people think, low volatility means lower return, which is actually not the case. And there's tons of studies out there that have proven that low volatility stocks have actually outperformed over the past 90 years. Now, it is an anomaly because they're not 100% sure exactly why, but I think a lot of that is you know, a lot of people have the mindset that some of these higher risk asset classes or sectors or specific stocks are more likely to have higher returns, which isn't always the case. And I think, you know, staying the course and staying invested proves that over the long term, you know, low volatility stocks have actually outperformed.
Thanks for that, Mackenzie. Hey, Chris, you've done a little bit of research here and brought together a nice little chart. And, you know, we talked a lot about low volatility anomaly and, of course, the reasons why Mackenzie talked about there. You know, give us a little background of the history on this and what you're seeing around the smoothing of the returns, because that's effectively we're talking about low volatility, is that smoothing of the returns.
Yeah, for sure. And I think, you know, the promise of low volatility, it should do two good things for investors. You know, number one is we want to have less drawdown versus the broad market. That's kind of number one, I think, benefit of a low volatility strategy. So, you know, what you can see here for illustrative purposes, we have the S&P 500 index versus its low vol counterpart. You know, not including COVID last year, there's been two real major drawdowns, which was the IT bubble in 2001 and the great financial crisis in 2008. You know, what you can see is when that red line goes down, the blue line is often quite stable. Even in the IT bubble, you know, that blue line was actually going up. So as those real high risk speculative IT stocks at the time were going down, you know, tried and true steady stocks were going up. So then again, the number one promise of low volatility investing that it's seeking to accomplish is less drawdown. And you know what, that puts you in a better position. If you draw down less than the market, puts you in a better position to have good returns going forward. And to Mackenzie's point, you know, in terms of that second really great feature about low volatility investing that's been, you know, articulated in these articles, academic research and so forth, is, you know, contrary to what you might believe, you're not giving up a lot on return. So if you look at this blue line coming out of the great financial crisis, you're getting a lot of upside with low volatility stocks. Again, that's interesting anomaly that investors have used in their favor, that these lower risk stocks have actually offered a better return source than high risk stocks, which sometimes investors kind of overreach and overpay for those higher risk stocks. So I think it's a great illustration of some of the benefits of low volatility investing.
So what you're saying is slow and steady really does win the race.
That's it. It's been proven out in countless articles that is a great way to approach investing, and I think certainly people could do a lot worse. Slow and steady is definitely, I think that saying goes back a few hundred, if not 1,000 years to some kind of tortoise race in ancient Greece, right, Kevin? Not to go too far off topic.
Yeah. Mackenzie, hey, now one of the nice innovations that ETFs have done is taken that kind of concept of low volatility and brought it to the market in a package. Talk to us about that, please.
Yeah, sure. And I think, you know, the appeal that, you know, a lot of people are concerned about risk, but they also want to participate in market returns, you know, and they want an easy, cost-efficient solution to do so. ETFs are a great investment vehicle in order to do that. And, you know, all the benefits that we've talked about in previous webinars, you know, cost efficient, easy to access, you know, diversified portfolio all apply. But when it comes specifically to low vol ETFs, you know, they provide lower risk than the market, while also providing the growth opportunity to help you participate. And they can also smooth out, you know, your returns over market highs and lows, as Chris showed in the previous slide. And then as well, with kind of the innovation in ETFs, and as we're seeing more and more ETFs come to market, you know, you can have precise exposures through different regional sectors or regions that you're looking for. So, you know, if you want Canada or US or EFI or emerging market, there's a lot of great solutions out there. You know, it's all managed for you, and it's something that you can just implement into your portfolio. And I think it's a great complement to many other strategies that you're using. And, you know, I think when you think of lower risk, you know, it's very hard to just pick that one stock, but with an ETF, you get that diversified exposure.
Thanks so much, Mackenzie. And I really think what you're seeing through ETFs these days, and this is actually brought up more than a decade ago in ETFs, is better portfolio construction tools. And so it's good to see that ETF companies continue to bring that to the marketplace. Hey, Chris, let's bring you in and let's talk a little bit about the different styles out there. Because when we say low volatility, of course, there are different approaches to looking at low volatility. Of course, these are reflected inside the respective ETFs out there. Big terminology here, bear with us all. We're going to say the word standard deviation and beta. Chris, walk us through those different methodologies.
Sure. Well, there's quite a few, and I don't think we've got time to walk through them all. BMO launched the first low volatility ETF in Canada. We use a beta metric, and I'll explain in just a second what beta is, but it's a measure of risk versus the market. There are other approaches here. There's standard deviation. There's different time frames on which you measure the data. There's optimization approaches. Some might involve, sector caps. I think the lesson here, Kevin, for me is, there's a lot of different approaches. They all result in different portfolios. So they might all be called low volatility, but you can get a lot of different results depending on the approach that's taken. So something as investors to definitely benefit to look under the hood and understand what you're investing in first and foremost.
Yeah, good tip. Look under the hood. Let's dive in for the audience here what the word beta means, because it may not be familiar for as much as the word standard deviation out there. So talk to us about that a little bit there, Chris.
Yeah, definitely. So beta is a relative metric of risk, and what it's relative to is the broad market. So if we're talking about Canada, for example, in our Canadian low volatility strategy, the ZLB, for example, when we're looking for beta, it's a measurement of a stock's fluctuations relative to the broad market. So securities with lower beta will tend to move less or less correlated to the broad market, while higher beta stocks will be, more risky. So, at a high level, think of your energy, your junior energy companies are going to be your, higher beta stocks, and your utilities, consumer staples, are going to tend to have lower beta. What we found in researching how to best create the exposure is beta is a very effective metric to identify these low volatility stocks. And what we do is use a 5-year metric. Also we tested a lot of different metrics. So as I mentioned, that's something you want to look at in your strategy. Having a 5-year metric, just capturing more data in terms of how a company's stock price moves versus the market, I think is a good thing, and it's a smoother metric, and one that we have found that works better. But yeah, overall beta is a measure of risk, and we found it's an effective one to classify securities to include in portfolios.
On a relative to the market basis, absolutely. Chris, now you talked about methodologies out there. Certainly for an example, portfolio construction, how does that ETF approach a low volatility basket being built?
For sure. So, what you're looking at here is how we build our ZLB, the Canadian low volatility strategy. But taking a step back, I think there's two ways you can really construct this kind of low volatility strategy. One is you can start, with the index, right, Kevin, and you can kind of tilt a little bit at the margin. Maybe you take out a little bit of energy at the top and put a little bit more into telecom, or you can do what we're doing, which I would say is less of an index tilt approach and more of what I would call a pure play. So if you look at our low volatility, we start with an index. So in Canada, it's the 100 largest stocks in the TSX. We look at each one of those stocks, we score them by beta, and what we do is we really seek to identify those 45 lowest securities, and those are the securities that are going to be included in the portfolio. And furthermore, the securities with lower betas, so lower risk by our measure, get higher weights in the portfolio. So I really describe this as what I would call a pure play approach to creating a portfolio. And we don't really care about the index so much, other than that gives us our selection set of companies to choose from. And I think the benefit in this space, when you circle back to those two kind of keys with low volatility, one is capital preservation and one is benefiting from the low volatility anomaly. When you have this pure play approach that really hones in on the lower risk securities, is willing to step away from the index, you get more of the benefits of those two approaches. So you would expect better downside preservation and better exposure to the low volatility anomaly, which is gives you that potential to have higher returns should that continue in the future. So I think a pure play approach like we're doing here really can allow investors to potentially get those benefits.
Thanks for that, Chris. Mackenzie, bring you back in. You got a little bit of historical analysis here of different approaches in marketplace, but really kind of demonstrating the benefits of low volatility, but sometimes, in a year like this year, maybe not, right? Talk us through this, please.
Sure, and I think just kind of building off what Chris had already alluded to, it's always important to look under the hood, because the way a ETF is structured and the way the different methodology that is used can have a great impact on your returns. So here is just a quick snapshot of the S&P TSX, versus some of the low vol Canadian ETFs in the marketplace. So providing exposure just to the Canadian market. And in some cases, as Chris mentioned, we look at beta and we use that as our metric, whereas a lot of other providers may look at standard deviation or optimization or whatever the case may be. But when you look across the board, you can see the variance in returns and how they change dramatically. So I think the underlying message is that you really want to look under the hood, understand it, and know what to expect in certain market conditions.
And then Chris, Mackenzie, we stay with you for a second. Just dive a little bit more, because we talked about the TSX there. Talk to us about, not just the TSX, but maybe beyond that when you look at historical views of the performance.
Yeah, sure. So here's just an overview, and I mentioned this earlier too, that with the innovation in ETF, and you're seeing more providers come to market, you're able to kind of slice and dice the market a bit more. So here's an example of the US versus the broad market, international versus the broad market, and Canada versus the broad market. So it kind of gives you a snapshot of three major markets and how low volatility compares to the broad market. And of course, and sometimes you are going to get that outperformance, or you're going to have similar returns to that market. So just when you're looking at this as a benchmark, depending what exposure you're looking for, just looking over the long term, that low volatility does provide that, less risk than the market, but also allows you to participate in market returns as well.
Thanks, Mackenzie. Now, Chris, we've been talking about, low volatility relative to the marketplaces, but some people may want to look at low volatility and the marketplace. Talk to us a little bit about low volatility as a complement to a portfolio, please.
For sure, highly complementary. Like I said, I think of it as a pure play approach. One that's not afraid to look different than the index. And anytime you look different, what that translates to in investing is diversification. So especially for investors who are concerned about downside, who maybe want to skew away from some of those more cyclical sectors that Canada's known for, like energy and materials, most namely, a fund like a ZLB could be highly complementary. And at the same time, a stock like Shopify, very successful stock, you're more likely to find that in a broad market index versus a low volatility portfolio, because as we know, Shopify is a growth company, has a higher volatility profile. So the two can be used and complement each other very well. And both are actually up this year about 12%. To your point on low volatility this year, both the index and the low vol are up 12%. So I'd even push back a bit on your point. The low volatility can perform pretty well even in this great macro backdrop like we've had. But again, they've taken different paths to that 12%. So again, taking different paths but getting to the same spot, that means better diversification. So very, very complementary to portfolios.
Yeah, well said, well said. The other thing too, I think we should highlight here too, Chris, is that when you look at a low volatility strategy, it's, especially the portfolios you're showing on the screen here, it doesn't just stay static. And so talk to us about that too, because the rules, of course, apply to volatility. Now it could change the portfolio, right?
Absolutely. So, it's an evolution. It changes over time. Certain sectors, their volatility profile changes over time. For example, REITs have become a little more volatile. We've reduced a little bit of weight to REITs compared to the middle of the screen. Energy, when we launched this strategy in Canada back in 2011, energy was, still riding relatively high with oil over $100. Energy's gone through some, massive ups and downs, including going to a negative price on oil last year. And as a result, we've trimmed energy over the years as well. So it's a constant evolution, and I think that's what you want in a strategy, one that's going to respond to the market as the market evolves, because it's certainly, the market is an ever evolving dynamic, so to speak.
So let's go through a little example how like low volatility approaches, deal with a company that has volatility come into it. And you got a good example. You brought up more known as Valiant in the marketplace, but walk us through this example too of how a low volatility approach kind of treated a company that became more volatile.
Yeah, for sure. So this is, it's a bit of a dated example from 2011 to 2015, but I just can't think of a better one. And we love this example to show the benefit of the strategy adapting, and also the benefit of a disciplined strategy. So this, remind you, Kevin, and as everyone knows, these strategies rebalance twice a year, and it's a disciplined approach. But Valiant, which is now Bausch Healthcare, but better known as Valiant back in these days, was a high returning stock. Went from $20, I believe, to a high of somewhere in the 300s, if not $400. Has come crashing back to $34 now currently, as it's known as Bausch. But was a very effective return generator. And as we rebalance semi-annually, essentially we were capturing value on this stock, every single time. So we actually turned a stock, and as these years evolved, Valiant took on more debt to do more acquisitions, and then they take on more debt, do more acquisitions. And it got to the point where they took on so much debt that ultimately became their undoing. They went from an investment grade to a very highly speculative company, and were essentially choked by their debt. And again, the discipline strategy, we captured value, every time we rebalanced the fund, and then eventually, with all that debt, the risk profile of the company increased, and we exited the company. We exited well before it fell to their lows. So I just think this is a great example of the benefits of a strategy that adapts, and the benefits of a disciplined strategy. Being disciplined in your approach is usually leads to good outcomes for investors.
Especially when you're focusing in this case on volatility, as we spoke about, that anomaly aspect.
Yeah, absolutely.
Mackenzie, bringing you back in, because we initially talked about performance and charts, and then what Chris had mentioned is you're winning by not losing. So talk to us about what we like the terminology in the industry called upside and downside capture, and how that relates towards low volatility.
Sure. So I think like as we've said throughout the webinar, you are going to participate. Not as much as you would as the broad market. You're still going to have some downside risk, but you're not going to take on that same risk as the market. So that's kind of the winning by not losing mentality. And here's just a quick snapshot of some of the upside and downside capture ratios of the market. So looking there, ZLB is a great example where they're capturing 28% of the downside and capturing 82% of the upside. So you're minimizing your risk while also capturing the upside of the returns to get that steady return that works for you.
And then Mackenzie, while we are providing low volatility ETFs, of course, there are other providers in the marketplace. Quick little screenshot, love Bloomberg screenshots. Talk to us about this chart here about the other players too.
Yeah, so earlier I talked about understanding, looking under the hood, just at the different way each ETF is constructed. And as you look here, you can see these are all Canadian exposure low vol ETFs, but all have quite different return streams. So over time, you do want to look at how each ETF is performing, depending on what works for you and what you're interested in, what complements your portfolio, the different construction of the portfolio. There's multiple options in Canada. So just make sure you are looking under the hood and, understanding what that return stream looks like in different market conditions as well.
Thank you for that. And just before we go to our lovely section on questions, maybe give us a little snapshot of the overall low volatility offering at BMO. And of course, I'll quickly highlight that we were the first to launch low volatility in Canada and currently sitting at one of the leaders in this solution set in the marketplace itself. So with that, let me get into the overall questions now, because I do love the fact that everybody takes the time and effort and send us the questions. And I appreciate those people that have done that, because that helps drive our content. In fact, today's session here on low volatility came from a question from the actual audience. So please keep sending those into us. It really helps us stay on topic towards what you want to hear in the marketplace. So let's kick off with a couple questions here. This one's on the pharmaceuticals industry itself, and what they're looking for is ways to play that through an ETF. Chris, can you talk to us about that, please?
The pharmaceutical industry, yeah. So we do have a healthcare ETF, ZUH. It would be our US equal weight healthcare hedged, and ZHU would be our unhedged exposure to that same equal weight basket. Healthcare is a big topic right now for good reason. Obviously, we've seen very strong momentum there. We continue to see it. There's a persistent concern about pharmaceutical prices, yet we still see these companies do very well. So, that's one thing as a Canadian investor, and we talked about complementing your portfolio. We don't have much of a healthcare industry in Canada. So again, you want to diversify yourself, and I think healthcare is certainly an exposure that is beneficial to have in your portfolio. And we all know the demand that's associated with healthcare. So you could look to those two ETFs, and I wouldn't view it necessarily from a make quick money approach, that there's going to be a short-term anomaly due to Joe Biden that's going to recover. But I'd look at it, integrating it in your portfolio, figuring out the right percentage that works for you, and look to make it a long-term buy and hold. And I think that'll increase your odds of having a better result.
Thanks for that, Chris. Now, inflation's been a topic that's certainly been trending since this year, for sure. We're seeing it out there. Chris, staying with you on this, how does somebody protect themselves from rising inflation? Give some ideas when it comes to using ETFs in that space.
Yeah, for sure. So, I think when inflation is going up, it means interest rates are going up, and generally that's associated with economy doing very well. So I'd say in general, this type of environment, it's a little bit difficult for bonds. You can look at equities to support your overall portfolio during this period. And if you look at, starting at a sector point of view, some of the exposures that work quite well, and we've seen this the past few months, but materials, energy, financials in particular, tend to do quite well in this type of environment. And from a factor point of view, value and dividend-based strategies, to that point, we've seen a lot of flows into our value ETF, ZVU, the US value this week. You can look at sort of some tilts in your equities, I think, to help support you in this regard. And then, you always have that fixed income as well as your capital preservation tool should equities sell off. So, you want to stick with your asset allocation, perhaps look to some tilts to value and dividends, could be beneficial for you, or for a more risk inclined investor, could look at some, base materials or some energy for some, continued profitability there. Those sectors have been on the run, and like I said, the factors are overall pretty good as well. But I do think, given the theme of the topic being low volatility, always stay balanced, always look at your portfolio from a total approach to make sure you're balanced on both ways.
Thanks for that, Chris. I'm going to stay with you for a little bit more. Hope you don't mind. In this case, kind of more of a background. Like, do passive ETFs, like index-based ones, protect somebody from the extreme volatility? in the marketplace. And then, is that really the point of index funds out there? Chris, can you talk to us about this, please?
Yeah, so you want to be careful. I think, the point that, there's the point of index funds is, I think they're simple and they're disciplined. In the ETF space, they're known for being low cost options. They've got great track records of performance, but it doesn't necessarily obviously immune them from risk. So, the S&P 500 carries a certain risk level. If you went into, say, the tech index or the financials index, that would carry a higher risk level. So, in terms of what drives the volatility or the risk profile, it's not so much being an index, it's you have to go to that underlying exposure, right? So if you're looking at a low volatility strategy, like we're talking about today, those will tend to be less risky stocks than the broad market. So it's not because they're index, they'll protect you, it's because you've tilted to an underlying that's more protective. So I think that's really, if you want to focus on having exposure to growth, but managing some of the volatility, if that's where this kind of the heart of this question is coming from, then I do think that's, the low volatility is there are potential ones that have been created to address that, again, get that equity growth and help manage some of the volatility associated with broad indexes.
And that's really one of the benefits of ETFs lately has been that focus on objectives approach to investing, as well as the traditional index-based approach out there. Mackenzie, given the time, I'm going to close out the session. There won't be a chance to get through all the questions today, but we will make sure you get an answer to those. We'll send you an email. Mackenzie, put a plug, and I appreciate that somebody sent this in. Does BMO offer an ETF that holds Canadian banks, and does it pay the dividend of each of these banks?
Yeah, sure. So yes, we do have a Canadian banks ETF, ZEB, which is an equal weighted approach, holding all the banks. And then we also have a covered call strategy as well. So if you're looking for a little bit more of a monthly income, you could also look at that, which is the WB. So two great options, and we do pay out what we earn. So everything is pushed back to the investor with a monthly dividend as well.
And that's a nice difference of an ETF. It does pay out a monthly dividend. We smooth out those yields on a regular basis that we collect from the respective banks and pass it right through to you. So with that, that's going to take us to an end of the session. What I want to highlight here, of course, is we're going to be back next week, May 14th at 1 o'clock. What are we going to talk about next week? We're going to talk about technical analysis, and specifically using ETFs to drive those market indicators across the board. So I hope you can join us at May 14th at 1 o'clock. And as in closing, I just want to highlight that this session has been provided for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered investment advice or a recommendation to buy or sell. Particular investments or trading strategies should be evaluated relative to individuals' risk tolerance and objectives, of course, there, and definitely seek professional advice for anything that you're looking at for any circumstance out there. Thank you again for joining us. We appreciate that. Look forward to joining us next week at 1 o'clock, May 14th on technical analysis. Have a good week ahead. Cheers.